everyone, and welcome to yet another episode of Fun and Learn Fridays with 5 Paisa. I am Deepika Asthana, your host for the evening. Now, markets have been making new highs on a fairly frequent basis. And honestly, for someone who might have entered the markets in the last 18 months, you would definitely be forgiven for thinking that equity markets move in only one direction, and that is up. There is, I think, recently no concept of a bear market. But anybody who spent more than 10-15 years in the markets will tell you that markets go up and down as well. So today, we are going to talk about how the markets have developed over the last 20-25 years with Mr. Swarup Mohanty, Chief Executive Officer at Mirrae Asset Investment Managers. With over 2 decades of experience in financial services, Swarup is someone who we can truly call a market man. Right from the post-liberalization days of the 90s to the recent COVID-19 pandemic, Swarup has seen the market through it all. And today, he has very kindly agreed to share with us his top 5 learnings from the markets through the decades. Hi Swarup, thank you so much for being here today.
Oh, Deepika, I should be the one thanking you for giving me this opportunity to be on your show. My pleasure, absolutely.
Thank you. That is very kind. Spoken like somebody who has actually spent more than 2 decades in the market. Very humble. So I'll just start with the 90s. And the 90s were a very interesting time for India. Literally everything changed. Stories of riches and crashes from that era include to hold fancy even today for many of us. And there is while several incidents took place at that time, I would love to hear from you any one incident from that time that had a particularly large impact on your learning and journey.
Absolutely, Deepika. You know, the 90s was, as I recall, when everything happened for the country. We were talking about liberalization and all of us, and I come from a family of teachers. Both my parents are professors in science, and I opted to get into commerce, and that was sort of a downgrade. But one of the main reasons I shifted to commerce was this huge change that was happening in the country. And I remember in the 90s, I started doing my MBA and I was in Delhi, and this huge thing of the Harshad Mehta scam. I'm so thankful that, they have a show now on the whole thing, so the young will actually come to know what had happened. And hell broke loose in India, at a time when it was just expanding and things were looking very positive on India. Here was one instance which made everything collapse, and whatever little as students then we were getting attracted towards the stock market. Suddenly it was in a tizzy, and what unfolded was an unbelievable process where there were some very early sort of learnings that, and please understand, as I had started my career in commerce, obviously I was looking forward to a career with money, and money would be the raw material. And the early realization that wherever there is money, there will be some kind of theft, and the need for a strong regulation or policy making was so important, because what happened then was just taking benefit of some of the loopholes of the laws. And what I learned very early in my life is that, especially where there is money, there is need for strong framework, strong regulator, strong rules which one has to follow. And I post that I've just become a man who feels there are 2 kind of people in the world. One is a lawmaker and one is a law follower. And I'm a very strict law follower. I don't question any rule or regulation, because especially in the mutual fund industry, the regulations have kept on changing, and a lot of people chatter about it. I don't question. There is a law and it needs to be followed. And that was a learning which came very early in my life.
Fabulous. I think for all of us, that's a great learning actually, because I don't mean to dismiss, but I think India mein thoda hai where law is not followed that closely. The letter of the law is not followed that closely in various aspects of our lives, right? Not just market or investing, but in various, something as simple as jaywalking or jumping the signal actually. So I think you're reaching to say something.
That wherever there is money, this happens. It is global. It's not just specific to India. Being Indians, because we are seeing it around us, we get to see it, but it's everywhere.
I will defer to your judgment in that. So just one more thing on this. You spoke about frameworks, right? And of course, there is great regulatory and order for the investment management industry. But if we drill down a little deeper, anything on investment frameworks as well? Because I know most investors, most fund managers have certain frameworks. How important it is then to stick to those frameworks while making investment decisions?
Actually, it is the process which is, we think it is a return generating business, but it is the return is an outcome.
Okay.
See, the whole thing about investing is it's a very disciplined business, and the more disciplined you are, the better the outcomes are.
Sure.
So hence the framework under which you work is critical. And no bigger example of this than Mr. Warren Buffett, because he's put a strict framework and he just followed it all through his life. Things which he does not understand and things which were also very big in rallies, and he wouldn't participate because it was not within his framework. But in spite of that, one made money. And look at the money that one has made. I mean, if you look at us as an example, and I give this as a learning, I learned so much from my CIO, Mr. Nilesh Surana, because he follows the framework to the T. And it's incredible. Sometimes I wonder as to how he's so very machine-like in following that process, that some of the outcome of the fund performance is a testament of following that principle more than anything else.
Sure. So I think you're absolutely right. I think in certain things, especially in investment, and like you started off with, where there is money management, it's very important to have discipline and frameworks. And this is true not only for the people who are managing the money, but even for us investors. When we start our investing journey as well, that amount of discipline is required.
Correct. Absolutely.
Okay. So I think from there we'll go back to the 90s, because like I started with, it was an interesting time for India. And I think also a time when we truly understood the meaning of globalization, right? The fact, initially globalization was all about getting exposure to all the good things that are happening in the world, right? But we also then realized that the globe is closely integrated. Then the good and the bad impacts everyone. So any lessons from that time which are more relevant, and especially today, they should be more relevant considering the COVID-19 pandemic and the lack of decoupling in global markets?
Absolutely. I think the first realization came in the 1997 Asian market crash. Please understand, by that point of time, I had started working and was exposed to how managing or this fiduciary responsibility that is our job. And I must say a very, very good job, because it is rare that people trust you with their money, and that's the job one does. And when the Asian market crisis happened, it was something which happened outside the country, and for no reason, the first time, if you see the Harshad Mehta scam was something which happened in India, so the impact on the markets was quite natural. But our markets went down some 28-30% for something which happened outside the country. So very early, and again thankful that it happened early in my career, that no longer was India isolated. I think it was the first, if I remember correct, probably the first time that money flow shifted from, say, the Asian countries, which were more stronger markets, to India. And China and India have benefited from that crisis, from a global money flow from then on. But it was, one has to really go back to that age and time to realize how big an impact it was, that something which happens in some other part of the world starts impacting you, and you realize that you are not alone anymore. And going forward, this can only increase, because as India was opening up, it was natural that anything and everything that happens globally would have an impact on our country. And especially the first brush of currencies, and subsequently, one would get the oil tremors from there on. But you learned that, this is the way forward, and not to be taken by surprise if some of those impacts come in. And it is natural that such an impact will only impact your country in both ways. There will be a negative impact, and going forward, you will learn to get some positive side out of it. But there is no respite from the fact that if something pretty substantial happens anywhere in the world, there is bound to be some tremor in your country as well.
As well. No, what you said makes sense, right? That let's not. I remember when I joined the markets in 2004. One of the things which one of my bosses had told me at that time was that when the US sneezes, the world catches a cold. That's how strongly we are all integrated, and through these events that have happened, I think we are also now better prepared to handle these sort of sharp movements in global markets which could impact. I think everybody now talks global markets rather than only domestic markets, which is
Yes.
Which is a good thing, right? I mean, now we also have so many international mutual funds which are being launched locally, which are giving us access to global investments as well. So it's good to be aware of how these dynamics impact our local investments as well. Perfect. So, so moving on now, let's get to the turn of the century. And I remember very well there was this whole hoopla around the Y2K destruction, which thankfully never came up. But while that did not pan out, technology definitely ensured that we started the century with a crash. I'm sure you know what I'm talking about, but maybe we can just discuss that with our audience, and especially how we were able to navigate that period, because now technology is playing such an integral role in our lives, in our business, in the way we work. So it's even more important to know how that works.
Yes, Deepika, I think, for me personally, what I went through in 2000 was something which changed my life perpetually as an asset management representative in the market. I just started selling. It was my early years of mutual fund sales, and trust me, I was selling funds with a lot more conviction that I do now. Salesman, I'll explain why. Because it was a return generation process, and stock markets were crazy then, clearly led by the tech boom, and we sold funds like there was no tomorrow. But what happened subsequently was shocking and nerve-wracking, because the realization that your 10 rupee NAV can crash down to as low as 2 was something which, even if I talk about it now, is what can I say, something which I'll never forget in my life, that you've taken money from people to create money, and people give you money to create money, and that's the beauty of our work life. And then it reduces to 20% or 25% of their principal value is just the fact that, or the realization that though it looks like a return generation business, it is actually a business of managing risks. And it was my first true brush with risk. And what has happened to me post that is understanding risks far better. I am not afraid of talking to you about the risk of any of my portfolios or any of my funds. Since then, I have not sold a single sector fund as a professional. And sometimes I'm being told that, I scare away investors more because I talk about the risks at length before an investor actually comes in. And that is because of what I went through. I mean, it was impossible to go out and meet people. It was impossible to go out and meet my partners. Because yes, you've said that this is going to do well, and this was the downside. And it was a very, very emotional experience for me, and the learnings from that time are cemented in me, and what it has done to me personally, and I think a lot of us who are there in the market have become more better assessors of risk, understand that there is risk and there is nothing called no risk. And I keep on saying that there is always a risk to investing. There is also a risk to not investing. One has to, be comfortable with the risk one is carrying. And everybody's risk profile is right. Everybody's risk profile is different. And as a seller, I don't mix my risk profile to that of anybody else's. Whoever is investing, they're right in their place, I'm right in my place. My job is to communicate risks transparently. If it then stops them from investing, it's a good thing.
That's great, actually, and I think this is also reflective of what you just started the conversation with about adhering to regulatory frameworks. and ensuring that there is a disciplined approach. Because one thing which really stood out for me right now was what you said, that you're not in the business of managing money, but in the business of managing risk. And unfortunately, now of course things have changed, and I think the industry talks about risk far more openly than back in the late 90s or pre the global financial crisis. But this whole thing around risk matching, right? I mean, as a retail investor, and I've been told this by many people, that your asset allocation and the investments that you make should be aligned with your risk. If that is the case, then you don't need to fear risk.
Absolutely.
So,
See, that is the whole thing. If you manage or you're invested somewhere where you are knowingly investing, knowing the outcomes of the risks, you are more at peace.
Okay.
You know, that is something which you can control. And it's about controlling the controllable. And please understand, your risk profile is also a journey. My risk profile at 25, 26 and my risk profile now are totally different. Your risk profile is also a factor of your life around you. Sure. Right? If I have a son who needs to be educated, I have to definitely provide for that. So the risk I will take is slightly lesser than what I would take if I had no dependency on me.
Sure.
Right. I give you a classic example. My mother is retired, and this happened today in the lunchroom. That is why I'm citing it.
Sure.
She is retired with pension. So she is a retired professor who invests 100% in equity. I don't invest 100% in equity. She says, my pension takes care of my life, so I am in a growth phase. That's her life. I am accumulating pension. She's actually in a pension stage. So nobody's risk profile is one, and one has to respect that, and that is, see, we are so lucky to be in a fiduciary role. It's by sheer luck that one gets this chance to do this role where somebody entrusts their hard-earned money to you with the objective of making more money. And there cannot be a bigger kick in life to be able to create money for somebody else. And then one has to safeguard that responsibility at all point of time.
Absolutely. And what you just pointed out about your mother, it's very interesting, because just recently I was reading one of the Berkshire Hathaway letters for some research that I was doing, and apparently Warren Buffett has advised his team that over 90% of his wife's money should be in equities. And so it just came to my mind that we always, so we no longer think about the 100 minus age formula, but even then, similar to what you just told me about your mom's investment portfolio.
No, because today it happened with my colleagues. She was shouting at me that why is my money in an ultra short fund? I was telling if the market's crashing, but they are not crashing. What is your problem? I want my money in equity is what she was telling me.
True, each to his own. I will leave it to that actually. And just one thing that I would like to point out there is, like you said, that it's a journey. Everybody's profile through the journey also keeps changing, and one must be aware of these changing dynamics along with the changing market scenario. So yes, I will leave that one at that. And so I think what is really important right now is, of course, the pandemic that is ongoing in nature and how it's changed our lives. Interestingly, not 12 years back, there was another event which was called an unprecedented black swan event. And suddenly we have another unprecedented black swan event. A lot has happened. Markets have reacted very differently in both these cases. So if you could just walk us through that.
Yes, you're so right that, what happened in 2008, 2009 was unbelievable. To say professional would have agreed to take any job in one of those 5 names which just went out of the market overnight was a terrifying moment that, no name is big enough, nothing is big enough. Everything can just go. And the market sort of reacted to it globally, and the crash was unprecedented. And for me, it was my first real brush at this kind of broad market crash. The first one was the tech, which was one part of it. Not all your funds were correcting, one part of your. But here, whichever fund you had, everything was out the window. What we were doing at that point of time, but huge learnings that such things can happen. More important is that markets are not under your control, and what is under your control is your asset allocation. right? There is that chance that these markets can give opportunities, and unfortunately, I didn't take that opportunity at that point of time. So, just looking back, when you look at the industry, 60% of industry SIP stopped during that time, right? And I, as a seller, because of no knowledge or anything of that sort, I had no defense for that. And I had no communication at that point of time. To be very honest, I was like a sitting duck. And that's something which should not happen, because if somebody is entrusted their money with us, I should be able to talk to them or guide them or give a particular view. But the fall was so free and so continuous that we were all taken by surprise, and we didn't know what to do, quite honestly.
Sure.
But when COVID happened, and I can be caught on print, I can be caught on media, because when COVID happened, I said, once bitten, twice shy. I went on a Facebook Live from our side saying that, and I fought with the regulators and AMFI that, this top SIP should not be allowed, because the reason for a person's doing SIP is volatility, and here was volatility in front of you, and you are running away at what can be the best time of your SIP. I have actually gone on one of my Facebook Lives saying that I will show you my account statement at the other side. Right, and this was the best time to rebalance. We've made at least, statistically I'll be right, because I would have made at least 50 presentations telling them that this is the time to rebalance. Because what was the learning from 2008, 2009 was every crisis has a start date and an end date. Excellent. And the world moves on after that. Yes, we have not envisaged this to be 1.5 years, but if you put yourself on the first day of COVID when you were staring death, possible death, today we made some progress. Sure. I do not know when this is, but I'm a vaccinated person. And I do believe the vaccination is one step forward towards, somewhere handling this entire pandemic. But what was under my control was the fact that this sharp market correction was an opportunity. I didn't miss that, and I can show you my portfolio on that. I'm a little, on a hindsight, all this looks good in saying that, suppose my loss on my equity portfolio was say 40% of my portfolio. Because I had money on the debt side, I wanted to switch 40% to make up that loss. I could switch the entire 40%, but I managed around 30-35%. And I knew that it would come back today or tomorrow, because the crisis would end. And more important, I think 2-3 other realizations came in COVID. One was the need for a good emergency fund. I'm very thankful that my job is still there and my cash flows are intact, but I've seen people going through that. So the realization that you must keep a strong emergency fund has cropped up in COVID. The other point which really came up, and I have corrected that also, is a far higher health insurance that I had. Not that I had a small one, but now I have a realistically big one. That too I corrected, which will, I feel, unfold going forward. Typically, when we plan our finances, we put an asset allocation grid. This much to equity, this much to debt, this much to global investing, or say this much to gold or whatever. Form a grid and follow it. Right? I used to rebalance it yearly as now. When I got a market cash, I rebalanced it due to that 40% crash. I got an opportunity. But apart from that, this is what we call a straight line financial plan. Okay. What happens is, suppose my goal is, say, tomorrow and today a crash happens. My money would go out of the window. So going forward, my learning from COVID is to graduate from a straight line financial plan to a glide path financial plan, where systematically you start shifting money from your risky assets to your safer assets as you near the goal. Okay. Suppose my goal is, say, 3 years later and I have accumulated some money, so some of it I will start shifting to safer assets. And so I get a safer landing on the day of the goal, and such crashes would get mitigated from a portfolio action basis. Because if my son is to be educated, say, 3 years later, he has to be educated 3 years later. It's a reality, right? So that is where it is. And as I said, a crisis always has a start date and an end date. The only thing you can control is your own behavior, and that is what I try to do. I don't look at the markets at all. And the other thing is, of the last 4-5 mistakes, or what can I say, experiences, is that one should never make the mistake of your previous crisis. In fact, build on it. And as a result, I'll be very honest with you, I'm waiting for the next crisis.
To apply your lessons from the previous crisis to the next one.
Yes, one can gain, because there is a start date and end date.
Sure. No, I mean, you're right. Everybody should try to take the benefit of hindsight. Unfortunately, not everyone is able to do that. But what you've just highlighted is so simplistic. So it's so easy to apply, right? And while many of us would have gone through some or none of the crises, but I think when we talk to people like you, and when you put together your experiences and your lessons, it's a big takeaway for investors today. Because like I started when I said, and it's so true, that young investors who probably entered the equity markets in the last 18 months, I think they probably don't even understand that there is anything like a bear market, right? Because markets have been pretty much unidirectional over the last 18 months. Nifty is making new highs. Just I think yesterday or today I read that this journey from 16,000 to 17,000 has been the shortest ever. So all of these new numbers are being thrown out, right? And everybody is very happy with that. So great. I'm going to try the best way that I can to summarize my 5 takeaways from this conversation today. And I will start with the most important. As you said, the underlying foundation for any system is the rules and regulations, and these need to be followed, because when these are not followed, then it's when the ecosystem goes belly up, and then nobody is left unscathed to that extent. Then we spoke about asset allocation and the importance of not having a straight line asset allocation, but a glide path where the allocations happen as per your unique circumstances, and you also continue to rebalance so that your unique circumstances are reflected in your investment portfolio. Then the bit about SIPs is very important, because while again over the last 1 year we've seen a lot of mutual fund and broking accounts, a lot of people entering the markets, but this is one mistake which everybody makes. At the moment the markets go down, they stop their SIP, and like you said, that is exactly the time when you should continue the SIP, because the benefit of an SIP is that it helps you ride the volatility. So always best to stick with your investments until as there is some change in circumstances. And I will end with what you said, that to every crisis there's a start date and there's an end date. And there's a lot to learn from each crisis which we can apply to the next one. So those are my takeaways from this conversation. But please, if you would like to share some last thoughts, some closing thoughts.
No, I completely agree with what you've said. You summarized it well, and I'll keep that clip of yours and keep it as a summary for myself. The fact is, when you are investing, please remember, volatility is your best friend, not your only friend, it's your best friend. The more you accept volatility and build it in your portfolio, the stronger you become as an investor. And in volatility always lies the opportunity. If there were no volatility, there would be no opportunity, right? So there is a risk to investing, there is a risk to not investing. At this moment, with the stage at which India is, the risk to not investing is higher. So people who are investing, just it's a good journey, and one should learn from the journey. And I have learned by losing a lot of money. I've learned that I'm not a good direct stock guy, so I invest with a fund manager. If it's not possible, it's not possible. I don't have that skill. What to do? Otherwise, I would be a fund manager. So there is nothing wrong, nothing right, and each one's investment journey is different from the other person. Because each one's life is different from the other person. The only thing I'd like to leave back, since you're asking, saying that, a lot of young people are investing, just one question that you ask yourself before you start investing, and it's a very powerful word called why. If you know why you are investing, where you are investing is easy. Typically, people spend a lot of time on where you are investing without knowing why you are investing. That is why you get the equation wrong.
That's it. Thank you. That the why in investing, and I think in your life as well, it's the most important, right? If you can answer your why, I think you're already on the path to something better. So that was beautiful. Thank you very much. I will just say one thing, that my learnings today have been more than just for the investment market. I think a lot of this can also be applied to life as well. So thank you very much for being here today, sharing these wonderful insights. And thank you, listeners, for tuning in. Until next time.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.